right, let's win family. I want to say good afternoon to you guys on this good day here. I'm excited here for our tax webinar. You guys always hear me. And so today you guys will have the privilege to hear from my better half of like what we call here in the Let's Win financial community here. It was formulated from my wife. She came up with the name Let's Win Financial, and so we have a couple other businesses that we own. So they all originate from Les Win in itself. So her name is Leslie. I'm privileged to have her, and also Jason Weinrup as well. He gave us previous sessions in the past as well. So I am just so honored and grateful that they're offering their time to come and give some tax information, their expertise here to the Let's Win financial community. And so, as I told you guys a little bit earlier, what's better than one CPA, two CPAs? So, you guys have two CPAs coming here to you today, giving you some good tax information here. So, without further ado, I want to go ahead and turn the tables over here to Leslie and Jason to give us our tax webinar session. So, guys, thank you again, and Let's Win Financial Community welcomes you.
Thank you,
Good
Sharon.
afternoon, everyone. Happy New Year. Am I still
Happy New
allowed to
Year.
say that? January is not over, and I haven't seen any of you yet. So Happy New Year. I would like to just introduce Jason and myself. We both have over 20 years each of tax experience, ranging from Big Four tax firms to mid-size, and now we work together in a smaller firm of about 10 people. But Jason has been my mentor and friend for many, many, many years, and everything I know tax-wise is I learned from him.
Thank you, Leslie.
So
I don't
today
think
we
that's true,
just
but
wanted we kind of wanted to take a moment just to give you guys some basic tax information, just to get you started for the tax season. Jason, did you want to say anything before we get started?
no, I think you pretty much hit it on the head. We have a wealth of knowledge between the two of us with all of our stops along the way. We are a one-stop shop CPA firm. So, any questions that you guys might have between the two of us, Leslie is more than capable. She's smarter than I am. So she'll be able to answer any of the questions that you guys will have. But we have more than one person here available for anybody's needs. If there's multiple calls or whatever else, we have multiple people that can respond and answer questions. So, we're happy to be part of the community. We're happy to give out a little bit of free advice, a little bit of knowledge of what's coming up, and just to give a little brief overview. If anybody has any easy questions or hard questions, could be talked about after the seminar. But any easy questions, feel free to stop us at any point or use the chat room. We'll answer any of the questions. But we'll give you a nice little 20-minute presentation that Leslie will kind of take on from here.
Okay, I'm going to go ahead and share my screen. I had it here. I just had it up, and now that I get off for some, okay, there we go. There. Okay, so today's agenda, we're just going to be going over some basic things. We're going to talk about the basic formula for individual taxation. We're going to talk about filing status, which I have noticed over the past few years that people have not been doing that correctly. So we're going to go over the tax brackets, whether you should take standard or itemized. We're going to touch on Schedule C, retirement plan contributions, Schedule E, and then we'll talk about some tax credits. So I can see everyone. Okay, so the basic formula for individual taxation. This is something that I think a lot of people, this is straight from the tax form, but just wanted to kind of make it in plain language for everyone. So you're going to have your total income, which is going to be all your W-2s, all of your investment income, all of your income that's going to flow through from businesses, from investments, from rental properties, all of that's going to go into total income. And then you're going to have some adjustments that come out from a separate schedule, Schedule 1, which we won't get into, but just know that there are certain adjustments that come out. We will talk of a few of them later. And then you're going to get to what we call AGI. I know a lot of you have heard AGI and you're like, what is that? Well, that is your total income less adjustments, is adjusted gross income. Okay, so a lot of tax, credits might be based on or phased out based on your AGI. So that's an important number to know. Also, if you ever have to like go to the IRS website and say, where's my refund? It may ask you, well, what was the AGI on your return? Or it may ask you, what was the refund amount on your return? Then we're going to take out either the standard deduction or the itemized deductions. And then you're going to get to your taxable income. Now, your taxable income is what is going to be used towards the tax rate. So, when you see the tax brackets every year that come out, the taxable income is the number that you will plug into that tax rate table to get an estimate of your taxes. Then you're going to take out any credits that you qualify, and then you're going to get your total tax. Now, your total tax will be netted with either your federal tax withholding or tax payments that you've made, let's say through estimated payments, or maybe you had an overpayment from the prior year that you applied to this year. And once you subtract those numbers, if you have a positive number, that means you owe tax, which is why it's in red, it's a bad thing. And then if it's a negative, then you have a tax refund, okay? So I know some people think the tax refund number is some arbitrary number, but it is based on your total tax calculated less what you paid in. So if you did not pay in enough withholding, or you did not pay in estimated taxes, the reason why you owe tax is because of that, not because the tax preparer did something wrong. Okay.
Leslie, let me just touch upon that real quick too, because
Yeah.
from a practical standpoint,
Mhm.
last year I noticed a lot of clients were confused why their tax refunds were less than the prior year. And what I noticed was that, first off, a lot of people that changed jobs did not fill out their W-3 correctly. And so they were taking less money out of each of their paychecks every single pay period. So you were getting more money on a weekly or biweekly or bi-monthly or monthly basis, but they were withholding less money, and that's the reason why you were getting more money. And so when you filed the return, there was a smaller refund. And that happens a lot. It's happening more and more each year when people are changing jobs because the form has become a lot more complicated to fill out. So just keep that in the back of everybody's mind.
There is an IRS calculator, and I believe I have a link to it on my last page, but it is very time consuming. It's very complicated. I did it because when I started this job 2 years ago, I noticed the withholding was much less than I was getting out at my other job. So I took the time and I had to put in my information, Sherwin's information, to come up with the proper amount of withholding. But I'm a CPA and I thought it was a little convoluted. So I can just imagine from, a non-financial background taxpayer, you really have to sit down and take an hour maybe to really put in all the information they require to come up with an accurate estimate. But quick and dirty, if you notice that on when you filed your 2023 return, you owed tax, that's your first indication that you're not withholding enough. Okay, so and if you just wanted to say, okay, well, my income might be similar to what I had last year and I owed $3,000, then your tax preparer should have told you to increase your withholding by at least $3,000 for the year. And then that would have been spread out. So if you didn't do that, you may owe tax again this year. And so you may want to consider, as soon as you file your taxes this year for 2024, if you owe money, you want to go ahead and reach out to your employer and say, I need to be withholding more money. And if you can't come up with the right formula, you could at least say, I would like to increase my withholding by, let's say, you're $3,000 short, divide that by the number of pay periods and ask your employer to withhold that amount additional per pay period for federal tax withholding. Okay. So filing status, a lot of people seem to be confused. It's pretty straightforward, but I have noticed in talking to people that it's not clear. So single is if you're unmarried, divorced, or legally separated. Legally separated means you've reported it to the courts. That's what legally separate. Like there's a legal document saying that you have officially been separated, according to what the courts know. If you have not done that, then you're not separated. You're still married. Head of household, you have to first be single to file head of household. You can't be married and just choose to file head of household because you don't want to file with your spouse. If you are single, you can file head of household. You have to have more than half of you have to be paying more than half of the living expenses for yourself and a qualifying dependent. Okay. If you don't have that, then you're just single. Now if you are married, the only two options you have are married filing jointly or married filing separately. You do not qualify as a married person for head of household. Okay. I want that to be clear. And so if you're married filing jointly, you are basically, filing both of you together. If you're filing separately, and I notice a lot of people do this and I don't understand why, because usually your tax benefits are going to be more if you're married filing jointly. There are some rare, and I say rare situations where married filing separately would be advantageous, or maybe you just don't want your funds commingled with your spouse because you don't trust them, but then why are you married to that person? So for whatever reason, there are reasons that people would do separately, but if you don't have one of those specific reasons, I would always say filing jointly would be more advantageous to the whole, meaning you'll pay less tax in total. Okay, our tax software does a comparison. We can input the spouse's information and the taxpayer's information, and the system will calculate for us what the difference is. And almost always that there is tax savings when filing jointly. Okay. The last one is qualifying surviving spouse. That's if your spouse has died during the past 2 years and you have a dependent child. I did not mention.
One quick second. I apologize. Apologize. Just on that same topic of the married filing joint, you did hit upon the point where we do have some clients come in here and they say, well, I have all the withholding on my W-2. Why should I have to pay my husband's tax? We keep separate accounts. Like there are some families that keep separate accounts. So, your CPA or whoever's filing your return should very easily be able to come up with the amount of tax that each of you individually are responsible for, so that if one person is paying all the tax, then they would know how much goes to each of you, where they could say, okay, well, your husband didn't pay enough in, he owes you $3,000, or vice versa. The spouse didn't pay enough in, so she owes more, or whatever the case is. We can figure that out. We would charge you because it does take some time to come up with those numbers, but don't file married filing separately for that reason, because we can calculate the amount, and it's 99% of the time, as Leslie said, will work out to be better tax to do married filing joint. So I apologize for cutting you off. I just want to make sure I hit that point home.
No, thank you. And then one more thing about the married filing jointly. If your spouse passes away, you can still file married filing jointly for that tax year. Right. After that tax year, if you have a dependent child, then you can switch to a qualifying surviving spouse. Otherwise, if you did not have a dependent, like let's say you're an older person, you don't have a dependent, then you would revert to single. So these are the tax brackets we talked about. So let's say in that formula, 2 slides before, you came up with taxable income. You would then come to this chart and say, okay, let's say you had, $100,000 of taxable income at the end of the day, and you're married filing jointly. So then the first 23,200 is going to be taxed at the 10% rate. The amount between 23,000 and 94,300 is going to be taxed at 12%. And then the remaining, let's say 5,700 is going to be taxed at 22%. Okay. This does not include capital gains, which is taxed at a separate rate. Okay. These are the numbers, the tax brackets for 2025, just for your reference.
And just so everybody knows, the tax rates are adjusted for inflation. So if you look at like the $100,000,
They went up, they go up a little bit every year.
Right. So somebody that was making 96,000 last year can make, 99,000 this year and pay the same amount of tax.
Okay. So standard deduction versus itemized deductions. Okay, these are the standard deductions for 2024, and then the upcoming ones for 2025. These also will be indexed for inflation. So you'll see they'll go up a little bit every year. They're really round numbers in 2025, which looks odd, but they go up for inflation every year. So if you do not put in any itemized deductions, this is what you will automatically get. Now, for a lot of people, this is the most deduction that they can get because they're not going to have enough itemized deductions. Well, what are itemized deductions? Well, medical and dental expenses. Remember, we talked about AGI before, and I said a lot of things in the tax law will be affected by how high or how low your AGI is. Okay, well, your medical and dental expenses, you can only deduct them if they are greater than 7.5% of your AGI. Okay, so if you have $100,000, your medical has to be at least 7,500. Okay, if it's not greater than that, don't even bother putting it in because you're not going to get anything. It's going to be a zero. Then the next line will be state and local taxes. So you have the option to do income tax. Now, if you live in Florida, you don't pay state income tax, so you're going to default to the state and local sales tax. If you live in another state, your income tax may be higher. So usually your tax preparer, the sales tax can be calculated based on your income. It's a formula. And then you can see if the income tax you paid is greater than that number, and you would just use whichever number is greater. Also in state and local taxes are real estate taxes. That is, if you own your home and you're paying taxes every year, that number would go there. When you add these two together, you're capped at $10,000. And if you're married filing separately, you're capped at $5,000. So whereas back in the day, if you paid a lot in real estate taxes and you had a lot of sales tax, this could be a high deduction, but it's been capped at $10,000. We'll see if that changes in the future. Home mortgage interest and points. Now, both of these numbers are usually reported to you on a Form 1098 MIS. That's mortgage interest statement. That it's made to report the mortgage interest, but it can also include real estate taxes if it's paid through escrow. The next line is cash charitable contributions. The IRS expects you to keep track of these receipts, especially if the amounts are large. So I do not recommend just dropping a number in there, hoping they won't notice. I would always, even if your tax preparer doesn't ask for the detail, I would always say, hold on to your receipts. Save emails when you make contributions online, save those emails, flag them so that if the IRS didn't want to justify your charitable contributions, you have a record of them. If you're paying tithes, this is important. If you're paying tithes or offerings to your church or any other religious organization, don't forget that also qualifies as a charitable contribution. So if you're paying a large amount in tithes and offerings, definitely you want to include that number here. Non-cash charitable contributions, that's like your bags of clothes to Goodwill. And when you go, you should always get a receipt from them and write on the receipt your estimated thrift shop value of the items in that. And there are softwares and calculators online that you can, say, okay, I donated 10 shirts of, and this, and they can give you an exact number if you're one of those people that just have to feel like, you're completely by the book. But I mean, if you have a reasonable estimate that I believe this bag of clothes, if I were to sell all these at a thrift shop, I'd probably make, $100 or $200. Then I would write that on the receipt and I would provide that to my tax preparer. Okay. And that is your backup for how your non-cash contributions are valued.
Leslie, keeping in mind, I don't know if there's a chart for the IRS that shows like thrift shop value of a lot of different things. And it's something that I wasn't even aware of until about 10 years ago, that they actually do have a chart for this kind of stuff. Like $100 shirt, which, I hope we all have them, but $100 shirt, you're only getting like a $10 thrift shop value. So if you give $10,000 worth of clothing to Goodwill or whatever charity, it's probably only worth, you know, 800, 900 to $1,000 of charitable contributions. So just keep that in mind. It's an area that is abused a lot. We all do it, and we will all err on the side of the client. You know, if they say no, it's $1,000, we're gonna put that number down. But we have seen where the IRS come back and audits them, and they say, okay, give me the list, and you know the client provides. I gave 300 shirts, 300 T-shirts, right? And they're gonna say, well, that was worth $30. You know, show me where the real value is. You put $1,000 on your return. So just keep that in mind that the thrift shop value is a lot lower than what most people think it is.
Okay, also keep in mind, let's say you donate your furniture to Salvation Army. Like that's a large item. You want to make sure you keep the receipt and the value of that furniture. Or a lot of people, they might donate like their kitchen cabinets before a remodel. Like those are all things. But any large items, you definitely want to have a value. If when they become really large, you may even need an appraisal. So keep that in mind if you're donating something very valuable that you may it may require an appraisal to be attached to the return. Another thing I'm going to mention but not really go into is casualty loss. A lot of people have suffered from the hurricanes last year. So if it's a federally declared disaster, like let's say Hurricane Milton, something that the government has declared federally declared disaster, you may be able to get a casualty loss if the value of the property has severely decreased, or should I say, you were not reimbursed for the repairs to restore the property. That may be something that you could qualify for. The rules are, you know, it depends. But if you did have a loss, you should definitely talk to your tax preparer about trying to calculate what kind of casualty loss you can take. And you cannot take it in the current year. It may be able to be carried forward in a later year. So Schedule C, profit or loss from business. This is something that I think would apply to a lot of people on the call. So a Schedule C is for a sole proprietorship. That means there's one owner. So I know a lot of you may feel like, you know, it's your husband and wife business together, but for tax purposes, if you want to legally show it that way, then that would be a partnership. Okay, a partnership files its own tax return, Form 1065, and any income or loss is reported to each partner on Schedule K1. And then the K1 income or loss is reported on Schedule E of your individual return. So if you have, you know, a business that's really just, you know, you just want it to be shown on a Schedule C, you're going to have to put who's the sole proprietor. So it would either be the husband or the wife. It can't be both. Okay. So even though you may feel like it's a family business, it has to be kind of assigned to one or the other. If you have more than one business activity, you must, and it doesn't even matter if, you know, you have one LLC and you're running all your businesses out of that one LLC. If you have more than one business activity, so let's say you have you have a real estate license, so you're selling, you know, houses, and then you also selling cosmetics, and you know, in your mind, oh, it's all this business. I call it all this business. No, if you have a separate business activity, it must have its own Schedule C. So you'd have the separate Schedule C for the real estate and a separate Schedule C for the cosmetics. Okay, so you should be tracking all your income and expenses for the real estate and all the separate income and expenses for the cosmetics business. Okay, so just some common, these are basically all of the expenses listed on Schedule C. Any advertising, car and truck expenses. Very important for car and truck expenses. You want to be tracking this. The IRS expects you to keep a contemporaneous log, meaning while you are incurring the expenses, before any time where the IRS comes to audit you, you have to have some kind of a log tracking your expenses for business use of your vehicle. You cannot get audited and then say, I'm going to go back and make that. They do not consider that contemporaneous, and they will not accept it. Okay, so you want to be keeping track of how you use your vehicle for business and how often, how many miles you're using. Also, you want to be tracking the total miles of your vehicle, because when they're going to want you to compare your business miles versus your personal miles to come up with the business percentage, if you're going to use actual expenses. Okay, so and then there's also the method where you can take the standard mileage rate times the number of business miles and just come up with a simple expense there. Okay, so either way, you need to know your business usage of your vehicle, how many business miles versus personal use miles, okay, or the total usage versus the business usage. Okay, commissions and fees, depreciation. If you are placing your vehicle in your business, you can take depreciation on that business. Also, any assets, I would say above $2,500, you would be depreciating. Any assets under $2,500, there's something we call a de minimis safe harbor that the IRS will allow you to make an election to expense those items directly under whatever category they would fit under. But any items 2,500 or more, you would be capitalizing them, showing them on a depreciation schedule and depreciating them. Now, right now, you can take bonus depreciation. Is it 80% for 2025? I know it used to be 100%.
I think it's 60.
Okay, so 80% for 2024 and then 60% for 2025. So on your 2024 tax returns, you will see bonus depreciation of 80%, which you may have been used to seeing 100%. You're only going to get 80. There's also something called 179 deduction. That's an option. Speak to your tax preparer about that. But this year, meaning 2025, it's going to go down to 60 for the tax returns filed next year. Okay, we have interest expense, legal and professional services. So whatever you pay a lawyer or a CPA or a consultant, that would go there. So do know that whatever you pay your tax preparer, that is a deductible expense on your business return, whatever is related to the business, that is. Office expense, rent expense, repairs and maintenance, supplies, taxes and licenses, like your annual renewal, travel, business travel. I should say business. You can't just put any travel in there. It has to be business related travel. You can't put your vacation to Maui. Deductible business meals. This year, if it's a qualified business expense, business meal expense, we're gonna be able to take 50% off. And utilities and any other business related expenses, you can put it in the other section, put a description, because a lot of times something may not fit under these categories, but is definitely related to an expense related to the business. You would just put in the other with a description. A very important thing, and I know Sherwin has probably mentioned this to those of you that it applies to, a SEP IRA contribution can be taken up to 20% of your Schedule C net income up to the annual limit. And we'll talk about the annual limits later, okay? The deduction is gonna come out on Schedule 1, line 16, but it relates to the Schedule C, so I'm gonna bring it up here. Okay, so retirement plan contribution. So what I said, the maximum for 2024, your maximum for a SEP is gonna be 69,000. So up to 20% of your net income from your Schedule C, you can take a deduction if you make a contribution to your SEP for up to 69,000. For 2025, index for inflation is going to go up to 70. Okay. So I know a lot of you guys are already familiar with these items because you're part of the Linswin financial community, but I'll just touch on elective deferral maximums for 2024 or 23,000. For 2025, it's going to be 23,500. We have for a traditional or Roth IRA, our maxes are 7,000. If you are over the age of 50 or older, you can do a catch-up contribution, which is limited to 7,500 for 401ks and 1,000 for traditional or Roth IRAs. And then I already talked about defined contribution plans, and SEP is going to be the 69,000 or the 70,000. So the deadline to make a 2024 traditional or Roth IRA contribution, including your catch-up, is going to be April 15th. It does not follow the extension. If you file an extension, though, your deadline to contribute to a self-employed Schedule C, SEP IRA, or a defined contribution plan, it is extended to the due date of the tax return. And I think that's because the amount you can contribute depends on how much you make. So if you haven't filed your tax return, it's kind of hard to estimate, how much you're allowed to contribute. So I think that's why the IRS is allowing the extension for those plans, whereas the other amounts are set amounts.
Leslie, let me just touch upon that real quick. The
Yep.
401ks, I have this conversation with every employee and every client that, if you guys are, and Sherwin, I'm sure you talk to all your clients about all this stuff every single year, but every time you get a raise, so if you get a 5% raise every single year, you should be increasing your 401k at least 1 or 2% of that 5%, so that you'll never feel the impact of putting more money into your 401k. Now, Sherwin will talk about diversifying with real estate, with CDs, with everything else. But when it comes to the 401k, you should really, first, number one, maximize whatever the employer is giving you. They're giving you 4%. Make sure at minimum you're doing the 4%. And then every year thereafter, every time you get a raise, keep bumping your percentage up 1%, 2%, 3% until you start to hit that maximum $23,000 per year. It seems like such a large amount of money when we're starting out in our jobs and everything else. But if you're doing 1 or 2% a year increases, you get to that number before you know it, and you would never feel the difference of that 1 or 2% per year because you're still getting an increase in your wage.
That's a great point. Okay, Schedule E, rental income and expenses. So if you have more than one rental property, you must report the income and expenses of each rental property in a different column. Okay, so you can't say, oh, I have 5 rental properties. Here's all the income. Here's all the expenses. You have to split it out by property. If there are expenses that, let's say you have one set management fee and they manage all your properties, I would do a pro rata allocation of that fee and then put an amount in each column. But you do have to, for IRS purposes, split it out to each property, okay? So some of the expenses are going to be the same as the Schedule C. Some of them are different. Advertising, auto and travel, same thing about keeping a log of vehicle usage applies here also. Cleaning and maintenance, commissions, insurance, legal and professional, management fees, mortgage interest paid to the banks, any other interest expense, repairs, supplies, taxes, utilities, depreciation, and any other rental property related expenses, like think of like your HOA or just anything. Like if you pay somebody to come paint, in between tenants, anything related to your rental property, you're going to want to hear. As far as depreciation, same thing we talked about on Schedule C. You can do the safe harbor election for items under 2,500. Items 2,500 or over, you would want to capitalize them, show them on your depreciation schedule, and then take depreciation. The depreciation life of most items related to a rental property are going to be a higher life. So you're definitely going to want to take advantage, if you can, the bonus depreciation if possible. But as far as like the building, like when you purchase a property, you're going to put the building and the land. You're going to have to allocate that separately because what you pay for the building includes the land, unless for some reason it doesn't include the land. And so you're going to want to pull out a piece of that, at least 10%. But I usually check the property appraiser website and they usually have an allocation for land. So I usually use that number, and that portion is not going to be depreciable. Okay, you cannot depreciate that portion of it. So you want to pull out that portion, and then at least when you sell the property, that's going to be your guaranteed basis. Okay.
Leslie, one other like legal side of, I didn't mention this on your Schedule C, but Schedule C's and Schedule E's, as you mentioned, should all be separately stated. I'm answering questions at the same time. That's why I'm If you have more than one Schedule C or Schedule E, as Leslie mentioned, they should be separated. But more importantly, make sure you talk to an attorney about liability. Okay, because the last thing you want, if somebody that has 2 rental properties or 3 rental properties, if somebody falls in one of your rental properties and they sue you, if you don't have them in separate entities or separate LLCs, they're going to sue you and try to come after all of your assets. And those other rental properties are other assets. So you want to make sure everything is separately stated for purposes of accounting, but also for, more importantly, for purposes of liability. You want to have everything separated so that they can't sue you and go after all of your other assets. So just keep that in mind as well.
Okay, so now we're going to just touch on some credits that I believe people may qualify for. So the child tax credit, it has a 7 tests to qualify. So age is going to be under the age of 17. Child must be son, daughter, stepchild, foster child, brother, sister, half sister, stepbrother, stepsister, or descendant of any of those people. So like your grandchild or a niece or a nephew. Dependent status, you have to be able to claim them as a dependent, meaning you have to be providing more than 50% of their living expenses. The child must have lived with you for at least half of the year. Like I said, you must have provided at least half of their support. They have to be a U.S. citizen, national, or resident alien, and they have to have a social security number or you can't claim this credit. And then income, the parents can claim $2,000 of child tax credit, $500 for other dependents that are not children. And if your AGI is below $200,000 for single and head of household, or $400,000 for joint filers, okay, and that's going to go up a little bit every year, indexed for inflation. After those thresholds, the credit reduces $50 for every $1,000 until it's completely eliminated. So per dependent child, $2,000. And then there's also, okay, and that portion is considered non-refundable. There is another line on the tax return called additional child tax credit. This is refundable, meaning if it goes above and beyond, if you don't have enough income to credit against, then you can take the lesser of 15% of your earned income over $2,500, or the unused credit amount up to $1,700 per child. So this portion is refundable. So that means it could be money in your pocket if you qualify. Okay. So definitely talk to your tax preparer about that. Now, dependent care. So we're going to talk about 2 different things considering dependent care. One is going to be a dependent care flexible spending account. I know we talked about this 2 years ago. I want to know if anyone actually took advantage of this since our last webinar in 2022. Has anybody since then opened a dependent care flexible spending account with their employer? And if you do, please let me know in the chat. Okay. So, and then the other thing that concerns dependent care is the child and dependent care tax credit. Okay. So both the dependent care flexible spending account and the child and dependent care tax credit only apply to child and dependent care expenses that are necessary for you to work. So the taxpayer and the spouse, if you're married, must have earned income. So let's say the husband works and the wife doesn't. You cannot take this credit because in the eyes of the IRS, well, the wife could take care of the child. So you would not qualify. You should qualify if the dependent is a qualifying child, so a legal tax dependent under the age of 13 when the care was provided, or a spouse who's physically and mentally unable to care for themselves and they lived with you for more than half of the year, or another dependent who is not physically or mentally able to care for themselves and live with you for more than half of the year. Okay, so you can actually claim your spouse as a dependent if they can't care for themselves, and then you would be qualifying. Okay, so that would kind of give you an exception to the spouse not working if they can't care for themselves. Okay, so if you have one dependent, then that credit is going to be calculated at, and it depends on your income, but it's going to range. If your income is lower, it's going to be 35% of 3,000, and you'd get the maximum credit of 1,050. As your income increases, the percentage decreases. So if you have 2 or more dependents, the max is 2,100. So how can you use both of these dependent care options together? Well, you can contribute up to $5,000 per year pre-tax, meaning you're not paying tax on this. It's coming out of your paycheck and you're not paying tax on it. And you're going to have that money automatically deposited into a dependent care flexible spending account. And that $5,000 is for married filing jointly or a single filer. The only thing about this, you have to be careful, is you don't want to put in too much. You want to calculate at the beginning of the year or whenever you're making your election at the end of the previous year. So you would have probably made this election in December. If you don't use it, you will lose it most of the time. So you don't want to put in more than you know you will actually use, okay? If you have 2 or more dependents, you could put $5,000 pre-tax into the DCFSA, and then you can still claim a dependent care credit on $1,000 of expenses. So, I mean, the credit's $350, but if you saw $350 laying on the concrete, would you pick it up? I know I would. So you can still get, you can still qualify for the credit on top of getting the $5,000 pre-tax. Okay, so a DCFSA can provide more significant savings for higher earning families. But like I said, you would have had to elect this at the end of the tax year. Now, let's say you're like, oh, but I'm pregnant. Oh, I'm about to get married. Oh, I'm about to, if you have a life-changing event, that usually will allow you to change your election. So even if the life-changing event may not affect this, you always want to say, oh, well, I just got married, or, I just had a child. I just adopted a child. I just, had a child pass away. I need to decrease my amount, hopefully that never happens. But, if you have a life-changing event, that would give you the option to adjust your election to what it is changing to be. And then the credit would be a good option for a family with lower AGI. Or let's say your employer does not offer a dependent care FSA, then you definitely want to take advantage of the credit, okay? Now, did anybody say in the chat, Jason?
Yeah, there's a few.
Huh?
There were a few.
Okay, good.
There were some comments about how, you lose you lose your child tax credit, but as you said, you don't lose the whole thing. It eliminates some of it. However,
you can't double dip.
If you're maximizing the 5K dependent care credit, it's literally getting a $5,000 credit. So you might lose the 1,000 on the child tax credit, but you're getting a $5,000 credit by doing it.
Yeah, you're getting a greater tax benefit by doing it pre-tax because you are not paying any tax on that $5,000.
Right. So it's as if you're getting a $5,000 credit.
So all electric.
A deduction. I'm sorry, not a credit, a deduction.
Okay. So a lot of people have been asking about the clean vehicle credit. And so I kind of wanted to touch on this because it's not as simple as the dealers, the car dealerships would make it seem. So there's 2 different ones I'm going to touch on if you purchase new or if you purchase pre-owned. So the top half of the screen, all electric, plug-in hybrid, and fuel cell electric vehicles purchased new in 2024 or after may be eligible for a credit of up to $7,500. Now that $7,500 is technically broken into 2 amounts of $3,750, but we're not going to go into that much detail. So your AGI cannot exceed $300,000 for married filing jointly, $225,000 for head of household, or $150,000 for all other filers. So if your income exceeds this, you do not qualify for the credit. The manufacturer suggested the MSRP of the vehicle you're purchasing cannot exceed $80,000 for vans, SUVs, and pickup trucks, $55,000 for any other vehicles. The vehicle has to have final assembly in North America. And what you may not realize, the seller is required to report your name and your social security number to the IRS for you to be eligible to claim the credit. If they do not report that information, you do not get the credit. So it's very important that, one, you're confirming that the vehicle qualifies. And I do have on the last page a link to a website where you can go see if the vehicle you're thinking of purchasing qualifies. And then you also need to communicate to the dealer and make sure that they are going to be reporting this transaction to the IRS so that you can claim the credit. Okay. And one thing I did hear recently, a lot of times they'll have you transfer the credit to them so that they can reduce the cost of the vehicle. But please, please, please make sure you qualify for that credit, because if you file your tax return and the IRS determines you did not qualify for the credit, you will have to pay it back. So you don't want, you don't want the dealership to get up on you. So just be smart on that. Now, if you're purchasing a pre-owned vehicle, 2024 after, you can be eligible to a credit up to 30% of the sales price, maximum $4,000. Your AGI cannot exceed 150K for a married filing jointly surviving spouse, 112,500 for head of household, 75,000 for all other filers. The vehicle has to be at least 2 years old, has to weigh less than 14,000 pounds, and it has to have a sales price of 25,000 or less. So just because it's used doesn't mean it qualifies. It has to have a sales price of 25,000 or less. So that rules out a lot of vehicles. And you must buy the vehicle from a dealer. You can't buy it from the neighbor next door. Okay. You have to buy it from a dealer who is also required to submit your name and social security number to the IRS in order for you to be eligible to claim the credit. Okay. So if nothing else, this should answer a lot of questions, because I've been getting a lot of questions on, oh, I just bought a Tesla, or, oh, I just bought this. And so you have to kind of go through and see if you qualify for the credit. It's not an automatic thing. Okay, earned income tax credit. I know a lot of you may not even qualify for this, but I thought I would mention it just for those that may. So the earned income tax credit equals the credit percentage, which is here, times your earned income amount, which is here, and this is the maximum credit you would get. Okay, so if you have 0 children, but you have earned income of this amount, you can get a credit of 632. If you have 1 child, it would be this percentage times this income amount. That would be your max credit. So for 2024, a taxpayer is not, oh, I skipped. For taxpayers with more earned income than the maximum dollar amount, the credit is phased out. And I do have, there's a whole chart for it, so I didn't want to list it here, but that's like 50 something. Okay, I can't pull it up quickly, but there is a chart. Basically, when your tax preparer puts your information into the system, it'll automatically calculate what you qualify for. But just know that if you have disqualified income that exceeds 11,600, you will not qualify. So what's disqualified income? That's your interest, dividends, rental income, capital gains income, and any passive income that is not considered self-employment income. Okay, so if you have 11,600 of that, that would be why you don't qualify for an income tax credit. But if you do qualify, this credit is refundable. And if it exceeds your federal tax liability, you will get a refund for the amount over and above your tax liability. Okay. So don't worry about the calculation as much. Just, I wanted you to, just keep an eye that if you think you qualify, if your income is low, to ask about it if you don't see it. Okay. So on the last page, we just have some resource links that you can click on, and I will ask Sherwin to distribute the slides so that they have access to these links. And so we have how to check your refund status. Here you have that withholding estimator. That's there. And if you need an EIN, Business and Self-Employed Tax Center. Most of these will take you to the IRS website. There's a couple that may take you somewhere else, but it'll take you to the exact place. If you need to look up an IRS form or instructions for a form or a publication about a certain topic, you can click this link. We have partnerships, corporations, S corporations, and then down here I have the clean vehicle tax credits. So if you want to see if the vehicle you're thinking of purchasing may qualify, you can click there, and there's a bunch of categories that you can go and get more information on that. Are there any questions? Feel free to unmute yourself and ask your question if you would like to.
David, if you can probably stop sharing your slides so maybe they can see you fully too.
Well, I just didn't know if they would want to reference anything.
I got you.
Well, I have a question. Good afternoon, Leslie. Thank you for sharing all
Hello,
this
Mr. Frank.
information. Good, good. Um, I have a question. I have two daughters, both of them in college,
Mhm.
and they reside with me. There's a form I think that's called the 8863 or 1090T. Can I use that on my income or because they both work? Could I use that on mine or they should use that on theirs?
It's going to depend on the
Would there be a
situation. It's going
penalty?
to depend on how much money they make. And it's going to depend on whether you're claiming them as a dependent or if they're filing a return that's saying that they are dependent of someone else. So that is you know, a specific question, and it's going to depend on their
Okay.
income and if they're filing their own return. Okay, but we can talk about that in more detail later.
Okay.
The answer to your question is it depends because you could do it anyway, but you want to make it so it comes out the best. How do you lower all of the family's tax liability? So which way is the best way to show it? It's not going to be a very easy answer because you have to know everybody's situation.
If your tax
Right.
preparer is preparing all three returns, then I would give them the information and ask them to figure out which one gives you the best benefit. And that's what
Okay.
if I get a 1098T, I'm gonna place it, I'm gonna drop it in real quick on the child's return to see what the benefit is. I'm gonna drop it on the parent's return to see what the benefit it is, and whoever gives me a better benefit, I'm gonna put it there.
Okay.
That's the answer I can give you.
All right. Thank you very much.
Okay.
I have a question.
Yes.
So I know it meant like earlier you were mentioning that you can obviously like write off some business expenses and travel related expenses if they tie to your business.
Yes.
So in my case, I have a travel blog. So I'm wondering like how do I need to demonstrate that the travel expenses are directly tied to, for example, like my travel blog, and what kind of those expenses can be written off?
Does your first question I would ask you if you're one of our clients is the travel blog generating revenue? That would be the first question I have to ask you.
Mm-hmm. Okay.
Okay, because
Are you a
if the
travel
answer,
agent?
No, I'm not a travel agent.
right, so if the travel blog is not generating revenue, then it's technically a hobby, and so none of the expenses would technically be deductible. Now, there are some very aggressive CPAs that might put it on a Schedule C, but if you don't have revenue to show for it,
Then it's
we
a
we probably would not. I would say that Leslie and I would not do it. We would not show
no.
the expenses.
Got
Now,
What
it.
I
figure
would
out a
say
way.
you could do is you could become an IntelliTravel travel agent, and I can help you with that after the call if you need me to. And then you would be able to write off the expenses of being a travel agent as well as the expenses related to your travel blog. And
Mm-hmm.
I wouldn't be writing off an entire vacation, but if you know that a certain percentage of your vacation you're taking videos, all of that to promote your travel business, then I would take a reasonable percentage of the travel expenses, and try to show the IRS that you're carving out your personal use of the travel, and you're documenting, a log of the business portion of the travel, so that if you were asked under audit, you could justify, well, this was the business related portion.
Got it. Okay, so like my
But
follow-up to that is that I do have one like LLC and I have three businesses under that LLC.
mhm.
So, how do I put it? It's like I'm trying to understand. So if I'm like only working under like one a main LLC, right? And let's say like my travel business is just a business within the larger LLC, so it's like a DBA. So let's say I'm making money like overall from like all the businesses collectively pooled. Would that work as far as like writing off those expenses?
But remember, all business activities have to be reported separately. So what are the other businesses?
Hmm. I see. Okay. Yeah, I do like marketing consulting.
Right. So if it's a separate business activity, then you would have to have a separate Schedule C.
Got it. Okay, okay. That's good to know.
Leslie, we have a question. Started a business in 2024, incurred a bunch of expenses to report them all together. So started a business to sell tickets for an event next month. Okay, but you incurred a lot of the expenses in 2024. So most taxpayers are on a cash basis for their Schedule Cs. If you're collecting deposits and the deposits are refundable, that would not be revenue. If the deposits are, I'm sorry, if the deposits are non-refundable, they would be revenue in the year you collect them. If you're paying out expenses in that year, then you would put the revenues on there, however much you collect as deposits, and then the expenses would be taken in that same year, which might generate a loss, possibly. And then the next year, when you get the rest of the deposits in there, you might actually have revenue because you'd collect more deposits than you would do the payouts if you're paying out all of the expenses up front. So hopefully that answered the question, but maybe you want to call in and discuss a little bit further because that can get to be a little bit complicated. But the point is that most taxpayers are on a cash basis. When the money comes in, it's revenue, and when the money goes out for expenses, it's expenses in the year that it comes in and out.
Okay, thank you, Jason.
Sure. Hopefully that answered the question.
Yes, that was clear. Thank you.
Okay.
Hey, Jason, Leslie, I want to thank you guys. We'll probably take one more question because you guys can probably answer questions all day, but we do want to respect your time for this great information that you guys have provided to us. So we would take one more question if anybody have a question, and then after this particular question here, if you guys don't mind, how can individuals work with you in the future? For his tax filing. So does anybody have, we'll take one more question. All right, so we do have one question. Do you guys do a tax review? You guys want to allude to that a little bit?
Sure. Leslie?
Hold on one second. I'm trying to show
Okay.
our contact
Why do you do that?
information.
So if tax review, you mean, hey, let me look at your last 3 years tax returns and see if something jumps out at me that it wasn't done correctly, or maybe we could find some more money to get a higher refund. Absolutely. We try to do that on most of our clients. I'll ask for either 2 or 3 years worth of prior tax returns, take a quick look at them and say, let me know what this is all about, because you may have left some money on the table. So yes, we always do a review of all of our new clients.
Awesome.
Okay, I generally ask for the prior year, but if you think that, you're speculating that you think you something may not have been right, then I would expect the client to tell me they want me to look at the past 3 years. Otherwise, I'm only going to look at the prior year. On the screen, you're going to see our contact information. That's our phone number, 954-744-8440. We're located in Plantation, Florida. If you happen to just want to see my face. But there are two owners, Jason and Clarissa, and then I'm here as well. We have a link on here once he distributes the slides that you can send us information securely. If you wanted, to send us anything, don't ever email anything with your social security number. That's the one thing you take away from this. Don't trust email. You should always have some kind of a secure way to send things if possible. And at the bottom in the fine print, it's really not fine. It's pretty legible. I'm just letting you know we're a CPA licensed firm. We have, like I said, Big Four experience. We've all three of us, Clarissa, Jason, and I, have worked in accounting and been CPAs for over 20 years each. We have a long history together. So, I know them well. It's not like, Clarissa's only been with us for a year, but I have worked with her for 15 years prior. So I know her knowledge and expertise, and, we all are here to support each other. Our fee, I know a lot of you might be curious on our fee. They're going to range between $200 to $325 per hour. And then our individual tax returns are currently starting at $850. Okay, so a simple return would be $850, but based on time incurred, depending on how neatly and cleanly you provide the information, The less time we have to spend, the less expensive the return is. Okay, so if you give me a mess, it will take longer and the return will cost more. So I know a lot of the times, first time I may, go back to the client and say, okay, here's how you can provide this to me better next year so that it costs less money. And we go from there.
And Leslie,
Okay.
two points that I want to add, just because I don't want people to get scared of our fees. But number one, most of us that work here, like Leslie said, have a ton of experience. And our previous firms, we were charging out literally $800, $900, $1,000 an hour. So we've created a nice little niche where we can do small businesses for a very reasonable hourly rate. I mean, you can't even get your oil changed now for $200 an hour. So that's
Nope.
number one. And then number two, we're actually looking at some of like the H&R blocks and the tax liberties and everything else. Like from what we're looking at, we're not that much more expensive than these guys that have no experience whatsoever. So you can't go into an H&R block anymore for if you have any kind of real information, a Schedule C or anything like that, you can't walk out of there without similar fees. So I just want to keep that, keep everybody in mind as far as that's concerned too, that we're kind of in a reasonable area for what our expertise is.
Awesome. Awesome.
Any
Well,
other
guys,
questions real quick? Okay.
well, they have your contact information. They can reach
Yeah.
out and we
So
start.
just to say, the best way to reach me is email. Okay, because even if I am not available at the time, I can always get back to you within 24 hours.
Got it.
My email is there, LRiley@THEFLACPA, the Florida CPA.
Got it. So guys, tax season starts next Monday, January 25th, and when you can start filing your return. So or your I don't want to say returns,
I
but your
believe they moved it to the 27th,
the 27th.
but
Okay.
yeah, I think
Okay.
the IRS pushed it back a couple of days.
Got it.
What I last heard.
So this webinar hopefully was able to kind of give you guys some information to help you start processing that information here. And so Leslie and Jason, I've known Jason before. I'm sorry, Jason and Leslie was working together when I first met Leslie, and just been a great guy, and appreciate Jason everything that you've doing. In Fort Leslie. And so just grateful for you guys coming in today and giving us this tax webinar. And so just again, thank you for your time. And we want to keep our community here empowered, enlightened, and educated on the tax information that's upcoming. So again, thank you. Would you guys like to have any final words here before we close out?
No, it's our pleasure. It's my pleasure.
Yeah.
Anything you guys need, Sherwin, I know you're building a nice little community over there. So I'll speak on behalf of myself. I'm always willing to have these little things for you guys to keep the knowledge going. Listen, we want to empower all of our clients to build wealth so that when taxes come up, they could pay their taxes, they could build their wealth, they could build their retirements. So I'm all on board on what you're trying to accomplish, Sherwin. So, anytime you need us, that's on behalf
Absolutely.
of me.
Appreciate that. Babe, any final words from you?
I'm just happy to be here and happy to see all of your faces. For those of you who have your beautiful pictures up. And if you have any questions, don't be afraid to reach out. Sherwin might be able to answer some of your questions, and if not, he has direct access to me. And then if it's something more, you can feel free to email me at lriley@theflacpa.com.
Awesome.
And I'll get back to you as soon as possible.
Awesome. Well, thank you guys again. Thank you, Let's Win Financial members, for plugging in. If you want to go back and see the replay, we will have it recorded. And as
I
always,
did want to say one more thing, and
okay.
I don't know why this just came to me. I know a lot of you may go on extension in April, but just keep in mind that even if you want an extension, whatever taxes due is due in April. So even if you don't, you don't have all your information, if you think you owe money to the IRS, it's better to pay in a certain amount in April and then get a refund when you actually file your return, because otherwise the IRS is going to charge you interest and penalties on the amount that you did not pay in April. Okay, so I don't know why that just came to my mind, but I should have said that earlier. So just
Leslie,
keep in mind.
it's a great way to finalize this conversation. And let me just add one little point to that. The interest rates, historically speaking, were very low. All right, if you had amounts due, you know, you might pay 2% interest on the amounts due. It wasn't that big of a deal. But now the interest rates are substantial. They're 7, 8%. So as Leslie mentioned, if you're going to go on extension, make sure you're covered because that interest and penalty amount is not insignificant anymore. Very great point that Leslie, great way to end the conversation.
Okay. So have a
Awesome.
great day.
Awesome. Awesome. All right, guys. That's what I was telling you a little bit earlier. It's not what's better than one CPA, two CPAs. Great wealth of knowledge here. So thank you again, Jason and Leslie and Let's Win Financial Community. Thank you for joining in. As always, be blessed and always let's continue to win. All right, guys. Have a
Okay.
great one.
Bye-bye.